In 1969, the Indira Gandhi government took a major decision that shook the banking industry. They nationalized the 14 largest commercial banks in India through the Banking Companies Acquisition and Transfer of Undertakings Ordinance of 1969. This basically meant that they took control of these banks and chose to retain more than 50% of their shares. This was a major decision, and effect of this can still be seen today. Before 1951, the banking scene in India was very different. The banks were only limited to major cities and they were owned by few powerful industrialists. Between 1951 and 1968, the banks expanded and their credit increased from 34% to 68%. However, the loans provided to agriculture were still very small at 2%. This highlighted a major disparity in lending practices. The economy took some hard hits in the 1960s. There were two major wars, one with China in 1962 and one with Pakistan in 1965, which provided major economic challenges. The issues were compounded by two consecutive drought years in 1965-66 and 66-67, which further exacerbated the problem. Overall, 1960s was a decade of major economic crises that challenged the resilience of the nation. Thus, on July 19, 1969, the 14 major commercial banks in India with deposits of over Rs 50 crore were nationalized. Quote, to serve better needs of development of the economy in conformity with national policy objectives. These banks were Allahabad Bank, Canara Bank, United Bank of India, UCO Bank, Syndicate Bank, Indian Overseas Bank, Bank of Baroda, Punjab National Bank, Bank of Maharashtra, Central Bank of India, India Bank, Dena Bank, and Union Bank. On February 10th the following year, the Supreme Court struck down this law, stating that it was discriminatory against those 14 banks. Particularly, they found that the compensation provided by the government was insufficient. In response, the government issued a fresh ordinance on February 14th, and then later that year, the Banking Companies Acquisition and Transfer of Undertakings Act was passed in 1970. Later on April 15, 1980, a further six banks were nationalized. These were Vijaya Bank, Punjab and Sindh Bank, Oriental Bank of Commerce, New Bank of India, Corporation Bank, and Andhra Bank. One of the key aims behind the bank nationalization was more financial inclusion. The banking sector was absent in the rural areas, and so the public trust in banks was significantly low. It was believed that by bringing the banks under government management, the trust in public would be returned and more people would participate in the banking sector. This was also aimed at improving lives of marginalized communities by bringing them into the financial system. The nationalization of banks in India brought some significant achievements. Some of them are branch expansion. So after nationalization, these banks were forced to open several branches in rural India. Reduction in monopoly. Once the banks were nationalized, they could not engage in unfair trade practices and push out the minor players out of the market. Increased savings and reduced misuse. Under government supervision, the funds were less prone to misuse, and as more people deposited their savings into the bank account, more money was deposited into these banks. And finally, more inclusive development, particularly in the agricultural sector and rural areas. National banks prioritize development of rural areas and poorer sections of the society, and thus more inclusive economic growth was achieved through the nationalization of banks. However, this policy wasn't without its criticisms. One of the major objectives of the bank nationalization was to address disparities, which failed according to an estimates committee of the Lok Sabha. Second was insufficient support of the primary sector. Despite higher lending to the agricultural sector, the overall primary sector lending was still quite low. Secondly, even after opening branches in rural areas, banks would not prioritize them. They were less maintained and the staff was not very helpful. Also, regional imbalances were still not addressed through the bank nationalization. And finally, nationalization led to low competition, which led to low profitability and more bad loans and non-performing assets, as several loans were given under political compulsion. A significant criticism of this move has been that it was politically motivated. At the time, Indira Gandhi was involved in a power struggle within Congress against the syndicate, which included old political leaders. She also wanted to regain ground lost by Congress in the 1967 elections. Morarji Desai, who was the finance minister and also a significant member of the syndicate, was also opposed to this bank nationalization. As a result, he was removed from office before the banks were nationalized. Even though the decision was taken several decades ago, it still continues to play a role today in our banking sector. Since 1991, the government has prioritized privatization of major national banks, and the political climate created during that time still provide a major hindrance in achieving this objective.